is the monetary base, and bank reserves are based on the monetary base. If you look at two graphs, one of the Fed's balance sheet, all the assets on its balance sheet, and they have to add assets to their balance sheet in order to put dollars into the monetary base. And a lot of those dollars are going to go into bank reserves. Some of the dollars go into other things, but a lot of them go into bank reserves. So as the balance sheet expands, bank reserves also expand. And you can see this going back all the way to 2008, when the balance sheet started to really peak a lot higher very quickly. Then you saw bank reserves become ample, or become more than before 2008. They were always like modulated pretty close to zero, only a few $1 billion or maybe tens of billions. And then all of a sudden 2008, and it goes into the hundreds of billions and then the trillions. So since then they've been substantial. And as the balance sheet expands, you have more reserves. And as it shrinks, every time they do QT, then reserves follow pretty quickly afterwards. And it seems now that hasn't been, the correlation hasn't been as tight as it's been between 2008 to 2020. After that, during the 2020 printing, they added, what was it, 4 trillion, 3 or 4 trillion, I forget the numbers anymore. Many trillions of dollars to the balance sheet, and that expanded reserves. I'm looking at the graph right now. Expanded reserves by about, let's see, what is this? This is from 1.7 trillion on March 4th, 2020 to, looking at it, 3.3 trillion. So what is that? 2.7 trillion, something like that, close to $3 trillion, and they kept going up. And they, as the balance sheet peaked, and it kept peaking, reserves went up and up and up. And so once they started to fall after QT started, then you had the regional banking crisis. You had the regional banks starting to.
You're watching Silver News Daily. Subscribe for more. Imagine waking up to find silver worth $1,000 an ounce. Sounds impossible. Rafi Farber says it's not only possible, but imminent. Stay tuned to discover why this precious metal could skyrocket overnight. Now, before you roll your eyes and dismiss this as another wild prediction, let's dive into the facts. Banks are over-leveraged, the dollar is rapidly losing its value, and the global financial system is on shaky ground. Rafi Farber, a respected precious metals analyst, has been analyzing these trends and believes we're on the brink of a financial meltdown that will send silver prices soaring. Trust me, you don't want to miss this breakdown. It could be the most important investment insight you'll hear this year.
And then I looked at the chart, zoomed out, and I was like, 34. Well, that's an all-time low, except for 1980. And then I looked at gold. Well, the gold to platinum ratio is at an all-time low. And for 100 years, from like 1910 to 2015, 105 years, the platinum has always been more expensive than gold, almost always. And then all of a sudden in 2015, something changed. Now we could speculate as to why, but the point is, if you've got a lot of silver, and it's bulky, and you don't, and it's making you a little bit nervous because how are you going to move it? Which is a situation that I'm in personally, because I might have to evacuate. Again, we were talking before that this is a particularly bad day for the north. In Israel here, we had like 5 or 6 fires around, and everything smells like barbecue. Nobody was hurt, but things are burned. So I don't know. Maybe I'll have to take my stacks and just like run away. I don't know. So it'll be easier to do that with platinum than it is with silver, though silver is much more liquid. So the thing is, if you've always wanted platinum, I wouldn't say start stacking platinum. That's not responsible. But if you've always wanted some, I think now is a very good time to do it, because if you trade some of your silver for platinum, it's very cheap. I think it's like 32 ounces now. It's even lower than when I got it. And you want to trade 100 ounces of silver for 3 ounces of platinum or so, go for it. It could be fun. I mean, and then if the ratio goes back up, you can buy back your silver or your gold and make.
All right, let's dive into the core of why this prediction holds weight. The first major factor to consider is the precarious state of the banking system. Banks today are more over-leveraged than ever before. They've extended massive amounts of credit, far beyond what they can realistically back up with their reserves. This creates a financial house of cards, one that's teetering on the edge. Rafi Farber points out that these over-leveraged banks are sitting on a ticking time bomb. When too many loans go bad, or when there's a sudden rush of withdrawals, These banks could face catastrophic failures. We saw a glimpse of this during the 2008 financial crisis. But according to Farber, the next collapse could be much worse. The interconnectedness of today's global banking system means that a failure in one major bank could trigger a domino effect, leading to a widespread financial panic. This over-leveraging isn't just a problem for the banks themselves. It affects the entire economy. If banks start collapsing, the ripple effects would be felt everywhere, from stock markets to job markets. And in times of such turmoil, investors historically turn to safe haven assets like silver. This flight to safety could drive demand for silver through the roof, pushing its price to unprecedented levels. If you find this information valuable, don't forget to subscribe for more insights. We're just scratching the surface of Rafi Farber's predictions and what they could mean for your investments. Stay tuned as we delve deeper into the factors that could make silver the investment of a lifetime.
And he was saying that the dollar would be the last currency to fall. And from a strict pyramidal perspective, with the dollar on the bottom of the pyramid and right under that gold and silver, then yeah, like everything would flow into the dollar. And like, in a sense, you could see how that makes logical sense, because when let's say a Venezuela or Argentina, when their currency dies, they go to the dollar. When anyone's currency dies, they go to the dollar. They dollarize, right? Everybody does that because the dollar is the base of the pyramid. So that's what you do. And you need liquidity, so you need a currency system. You need a division of labor. That's what you do. So on that basis, just looking at that perspective, then yeah, the dollar would be the base of the pyramid. It would be the last currency to fail. But here's the thing. Now, if Argentina fails, or Zimbabwe fails, or Venezuela fails, or some third world country somewhere, right? They're not a very integral part of the Keynesian system. They're a part of it. They're somewhere in the pyramid, but they're very, very minor. Even Argentina, which is like a G20, and you could say that it's a respectable economy, at least when it's functioning, it's still not very big. But then you think about, like, what about Japan, right? This isn't just a pyramid. Right? This is like a hyper pyramid, 4-dimensional, whatever. I mean, I'm just, I took a class once on these multi-dimensions. They showed us a hypercube and how it moves in the fourth dimension. So, try to imagine a fourth dimensional pyramid, and you have Japan here, and they've taken the bottom of the pyramid and they've like stuffed it into their own thing by buying all these treasuries. So what happens to Japan if the yen falls, right? They go to the dollar. I mean, they already own $1.5 trillion in treasuries. So what happens when one of those countries that has its hand like right in the bottom of the pyramid itself with all the treasuries that it owns? What happens when its currency fails? So then you have like some kind of like pull from the middle. I mean, I can't even describe what it's going to be, but we've never been in a situation where a country with major holdings in the dollar itself has a currency problem, right? That's a whole new problem for this pyramid or hyper pyramid or however the hell you want to describe it. I don't even know anymore. We've just never seen it before. So we could be just to think through it logically. If the yen really starts hyperinflating, right? It's like 161 now. So what if like tomorrow it opens up? I'm not saying it's gonna happen, but what if theoretically tomorrow it opens up at 200 and then it goes to 240 by the end of the day? What is Japan supposed to do? Right? The only thing they can do is dump all the treasuries on the market. They can't do this either because it would destroy everything. You see what I'm saying? So if we head into a situation where the yen really is hyperinflating, you've got $1.5 trillion in treasuries, or however much it is, 1.1 trillion. It's over $1 trillion. You have all those dollars in treasuries that are vulnerable, and you got to do something with them to save the yen, or not save the yen. And then what happens? Then all the trade with Japan, that's part of the trade cycle of this whole Keynesian nightmare, falls out of the loop. And then what happens then? I don't know. It's not.
Now let's talk about another critical factor, the rapid decline of the dollar's value. The US dollar, long considered the world's reserve currency, is losing its purchasing power at an alarming rate. This decline is being driven by several key issues, including massive government debt, relentless money printing, and dwindling confidence in the dollar on the global stage. Rafi Farber has repeatedly warned that the Federal Reserve's monetary policies are leading us down a path of inevitable hyperinflation. By continuously printing money to fund government spending and bailouts, the Fed is effectively devaluing the dollar. This devaluation means that each dollar buys less and less over time, eroding the wealth of anyone holding onto cash. Hyperinflation isn't just a theoretical threat. It's a very real danger that countries like Venezuela and Zimbabwe have already faced, with devastating consequences. But why is the dollar's decline so critical for silver prices? When fiat currencies like the dollar lose their value, investors seek out tangible assets that can retain their worth. Gold and silver have been trusted stores of value for centuries, especially during times of economic crisis. As the dollar's value plummets, more and more investors will likely flock to silver as a hedge against inflation and currency devaluation. Farber highlights that this shift is already beginning. Countries like China and Russia are reducing their dollar reserves and increasing their holdings of gold and silver. Even institutional investors and hedge funds are starting to diversify into precious metals. This growing demand for silver, driven by a loss of faith in fiat currencies, is setting the stage for a significant price surge. To put it into perspective, think about what happens when a popular product suddenly becomes scarce. Prices shoot up as people scramble to get their hands on it. The same principle applies here. As the dollar's value declines and hyperinflation looms, the rush to secure silver will drive its price higher and higher. But that's not the end of the story. The consequences of a declining dollar and hyperinflation extend far beyond just silver prices. They impact every aspect of the economy, from food prices to housing costs. It's a complex web of cause and effect that Farber has been meticulously unraveling in his analysis. So, what does all this mean for you as an investor? How can you protect your wealth in such uncertain times? To answer that, we need to look at the broader economic landscape and understand the underlying forces at play. We talked about over-leveraged banks and the declining dollar, but there's another piece of the puzzle that's crucial to grasp: the inevitable consequences of hyperinflation and how it will reshape the financial world as we know it. Stay with us as we delve into these critical issues and uncover what they mean for your financial future. If you find these insights valuable, make sure to subscribe to our channel for more expert analysis and up-to-date information. And remember, we want to hear from you. What do you think is the biggest factor causing the dollar's decline? Let us know in the comments below as we continue to explore the forces driving silver's potential rise to $1,000 an ounce. Up next, we'll dive into the inevitable hyperinflation consequences that Rafi Farber warns could be just around the corner. Stay tuned.
It's interesting. I haven't had any deep thoughts about platinum ever. It's not something that I look at, and it's not really a market outside of money that I understand so much. I do know that I've read in When Money Dies and stories of the German hyperinflation, people were also hoarding platinum. It was a thing because they were trying to preserve their wealth. I mean, gold and silver were primary, but platinum is secondary. I mean, in my thinking, there's no such thing as an objective money. There's degrees of liquidity among commodities, right? And the most liquid one will be money. If you're in a prison, it'll be tuna cans or mackerel cans. If it's Virginia in the 18th century, it'll be the most liquid commodity, which was tobacco back then, because they didn't have enough gold or silver to base an economy on it. Whatever, it's always the most liquid commodity. So platinum is never the most liquid commodity, so it's never going to be the money. But as commodities go, it's pretty damn liquid. Right? It's much more volatile than gold and silver, but it's much less volatile than, oil or wheat or something. Maybe it isn't. It's a better money than wheat and oil because oil burns and you can't really carry it. But okay, we all know this. What I noticed was that when someone came to my house and wanted some silver for a platinum coin he wanted to give me, so I just looked at the ratio and I was like, 34. I just calculated. I didn't look at a chart. And it was 34. So I gave him 34 ounces of silver. He gave me a platinum coin. It was fun. And it was my first platinum coin ever. I never had one. So I didn't want to import one because, all these taxes and it's annoying. So
let's delve deeper into the looming threat of hyperinflation and its inevitable consequences. Rafi Farber has been vocal about this for years, warning that the current monetary policies are leading us straight into a hyperinflationary spiral. But what exactly is hyperinflation, and why should you be concerned? Hyperinflation occurs when a country experiences very high and typically accelerating rates of inflation, eroding the real value of the local currency. This isn't just a slight increase in prices. It's a runaway train where prices double, triple, or even more in a short period. Farber argues that the Federal Reserve's relentless printing of money is laying the groundwork for this very scenario. When the money supply increases without a corresponding increase in economic output, the result is more money chasing the same amount of goods and services, which drives prices up rapidly. We've seen historical examples of hyperinflation in places like Weimar Germany, Zimbabwe, and more recently Venezuela. In these cases, the local currency became practically worthless, and people had to carry bags of money just to buy basic necessities. Farber warns that if the current trajectory continues, the U.S. could face a similar fate, albeit in a modern context. One of the critical points Farber makes is that hyperinflation doesn't just erode the value of money, it destroys wealth. Savings can become worthless overnight, and fixed incomes can no longer cover basic expenses. This creates a sense of panic and urgency among the population, leading them to seek refuge in assets that hold their value, such as precious metals. Silver, in particular, is poised to benefit massively from this flight to safety. But why silver, and not just gold? While gold is often seen as the ultimate hedge against inflation, silver has a unique dual role. It is both a monetary metal and an industrial commodity. This means that as the demand for silver as a safe haven increases, its industrial applications in technology, solar panels, and medical devices also boost its value. This dual demand can create a perfect storm for silver prices, pushing them to unprecedented heights. Rafi Farber emphasizes that we are already seeing the early signs of hyperinflation. Look at the rising costs of groceries, housing, and other essentials. These are not isolated incidents but part of a broader trend. As confidence in fiat currencies wanes, more people will turn to silver to preserve their wealth, driving up prices even further. Hyperinflation also leads to social and political instability. As the cost of living skyrockets, people's frustrations mount, leading to protests and unrest. Governments may respond with more aggressive monetary policies, exacerbating the problem. This creates a vicious cycle where hyperinflation feeds instability, and instability feeds hyperinflation. Farber's analysis suggests that hyperinflation is not just a possibility, but an inevitability given the current economic policies. The question is not if, but when it will happen. And when it does, those who have prepared by investing in silver could find themselves in a much stronger financial position. As we navigate these turbulent times, it's crucial to stay informed and proactive. If you've been finding value in this discussion, make sure to subscribe to our channel for more in-depth analysis and timely updates. And remember, your input is invaluable. What do you think is the most significant consequence of hyperinflation? Share your thoughts in the comments below. Next, we'll explore the physical supply constraints of silver. With demand skyrocketing and supplies dwindling, how will this imbalance impact silver prices? Stay tuned as we continue to uncover the factors that could lead silver to reach $1,000 an ounce.
You have this phenomenon of very low pending sales. I think the lowest since, well, I don't remember what I said, since the 90s, or even lower than the lockdowns. I remember that. It was lower than if you have fewer pending home sales than when it was illegal for anyone to do anything, you're in a problem, right? So the question is, well, then why are home prices going up if nobody's selling anything? If there's no transactions going on, why are prices still going up? Well, people have mortgages from when interest rates were very, very low, and why would they sell them if it's easy to pay those monthly payments? You could just rent out the house, so you wouldn't sell it. You just hold on to it and then use it for income, or just live in it, or whatever it is that you have. Then you'd have a situation where there'd be very, very few houses for sale, and those houses for sale are still going up. And meanwhile, who's holding on to these mortgages that are underwater? The banks. So a low pending home sales number with high mortgage rates currently means that these people do not want to enter into new mortgages because they'd be much higher rates and they have to pay a lot more. So they're just keeping what they have, and the banks are stuck with the bill. So we're going to have a banking problem. Right now, they're stuffing it away into unrealized losses, and this is part of it, right? These mortgages that they're losing on because they're getting these payments that are very, very low from the low interest rate era, and now interest rates are much higher. So the costs of their capital are going higher and higher and higher, and what they're getting from their mortgages that people are paying them for the loans that they made is much lower because it's from back in 2021 when interest rates were like zero. So it's the same situation that happened with Norinchukin Bank, right? They're earning very, very low on their bonds on their portfolio, and they're paying a lot because short-term interest rates are very high. So it's the same with every bank now, and you can see that in the pending home sales.
Now let's turn our attention to the critical issue of silver supply constraints. Rafi Farber has been highlighting the disconnect between the physical and paper silver markets for years, and this is where it gets particularly interesting. The physical supply of silver is under immense pressure, And this is a key factor that could send prices soaring. First, let's talk about the basics. Physical silver supply is limited. Unlike fiat currencies, which can be printed at will, silver must be mined, refined, and distributed. This process is not only time-consuming but also subject to various limitations, such as mining capacities, geopolitical issues, and environmental regulations. Farber emphasizes that the existing silver reserves are being rapidly depleted, especially given the increasing industrial demand from sectors like electronics, solar energy, and medical technologies. Countries like India and China are major consumers of silver, and their demand continues to grow. In India, silver is traditionally used in jewelry and investment, while in China, it's a crucial component in manufacturing and technology. This high demand is often not reflected in the paper markets, which are dominated by speculative trading. Farber argues that the paper-silver market is significantly larger than the physical market, leading to a situation where the price of silver does not accurately reflect its true scarcity and value. To understand this better, consider the concept of naked short selling in the paper-silver market. This is where traders sell silver they don't actually own, betting that they can buy it back at a lower price later. Farber points out that this creates an artificial supply of silver, suppressing prices. However, when investors demand physical delivery of silver, it exposes the lack of actual supply behind these paper contracts. This is what Farber refers to as a potential short squeeze scenario, where the demand for physical silver overwhelms the market, leading to a dramatic price increase. Supply constraints are further exacerbated by dwindling mining outputs. Major silver-producing countries are facing declining ore grades, making it more challenging and costly to extract silver. Additionally, political instability in key mining regions can disrupt production. For example, recent regulatory changes in Peru, one of the largest silver producers, have created uncertainties around future silver supply. The supply crunch is not just a theoretical issue, it's happening right now. The Silver Institute projects global silver demand to rise to 1.2 billion ounces in 2024, driven by industrial uses in photovoltaics, solar panels, and the automotive industry. This significant demand increase underscores the tight supply conditions that Farber often mentions. When demand outstrips supply, prices have only one way to go, up. Moreover, Farber notes that speculators have largely fled the silver market, which he sees as a bullish sign. This clean-out of speculative interest lays the groundwork for a more stable and sustained price increase driven by genuine demand for physical silver. With fewer speculative forces at play, the market is more likely to reflect the true value of silver based on actual supply and demand dynamics. But the story doesn't end here. These supply constraints, coupled with increasing demand, create a perfect storm for silver prices. The question then becomes, how high can silver go, and what does this mean for you as an investor? To answer this, we need to look at the broader economic instability and how it further amplifies the bullish case for silver. So stay with us as we dive deeper into the economic instability that Rafi Farber warns will act as a catalyst for silver's meteoric rise. This interconnected web of factors sets the stage for silver to potentially reach $1,000 an ounce. If you found these insights valuable, make sure to subscribe to our channel for more expert analysis. And don't forget to share your thoughts. Do you believe that silver supply constraints will drive prices up? Let us know in the comments below. Next, we'll explore how economic instability can further drive up the demand for silver, creating an even stronger case for this precious metal's rise. Stay tuned.
I was like, what is causing markets to go up? What is causing this sort of quasi-boom sort of conditions that we're having still? It doesn't seem to make any sense, because I said the money supply has been falling since 2022. It's been falling for 2 years. And Austrian business cycle theory says that if the money supply is falling, you have to enter into a bust. Right? So he answered, he says, I don't really follow money supply. I'm not like a monetary quantitative theory. Fine. So, it's a little different way of looking at things. Okay. And he says, well, I follow interest rates. So I said, yeah, well, interest rates are also higher. We're still like 5.5% interest rates on 3-month. And it doesn't seem to be causing a bust. In 2018, 2019, we went up to like 2% from zero. And then all of a sudden there was like there was a repocalypse, and there was this Chinese pressure on the yuan or something. It looked very dire, and it looked like we were entering a bust. And now we're at 5.5%, and we still haven't had that bust. So Keith said, he was talking with his golf buddy, and his golf buddy had gone. I'm not getting the story exactly right. You can listen to the interview on my channel if you want to see exactly what he said. But he did say that the regulators and I guess, I don't know, the head honchos of the financial system or bank CEOs or whoever it is that needs to take out more debt, regulators are allowing them to take out more debt by buying junk bonds without the requisite capital requirements of like, let's say if you wanted to buy a junk bond in, say, 2015, 2016, you need to put up X amount of capital, and now you don't. And why do you not need to? Because they want to keep those credit spreads narrow, and they want to continue the boom. And this is the way to do it, just like get rid of all the requirements. It's akin to what did the Fed do right after the COVID lockdowns? They said, 0% reserve requirements. It's the same sort of thing. Like, so if you want to buy junk bonds now and you're a financial institution or you're a big company, you can buy these junk bonds and not have to put up as much capital. So that allows the system to go into more and more debt, and that will keep reserves that should keep reserves more levitated than they otherwise would be. But there is a limit to that also. Right, you can't just keep buying junk bonds and then what if they get defaulted on, and then you're in the same problem, right? These defaults are going to happen because interest rates are high and somebody's paying the interest rates, so somebody's going to default. So this will only last for so long, and then it'll be over. So the question is it over now, or do you have more few drops in that towel that you can take a huge hydraulic press and squeeze out a few more drops? I don't know. I just know the inevitability here.
As we continue to build our understanding of why silver could skyrocket to $1,000 an ounce, we must delve into the broader economic instability that underpins Rafi Farber's analysis. Economic instability is a potent driver of precious metals prices, and silver is no exception. Let's unpack how various facets of economic turmoil can significantly impact silver demand. Economic instability manifests in many ways: financial crises, political upheavals, currency devaluations, and even natural disasters. Each of these events creates uncertainty and fear, which traditionally drives investors towards safe haven assets like silver. Farber often discusses the potential for financial crises, including the collapse of major economies such as Japan. These crises could have a domino effect on the global economy, further destabilizing already shaky financial systems. Take the example of Japan, an economy struggling with massive debt and a weakening yen. Farber argues that Japan's economic troubles are just the tip of the iceberg. The country's colossal debt to GDP ratio and aging population create a precarious situation. If Japan's economy were to collapse, it would send shockwaves through the global markets, causing a flight to safety. Investors seeking to preserve their capital would likely turn to silver and gold, driving up their prices. But it's not just Japan. Other economies, including those in Europe, are also teetering on the brink. The Eurozone is plagued by debt crises, political fragmentation, and economic stagnation. Any significant economic downturn in these regions could lead to a rush into silver as a safe haven. Farber suggests that this is a key reason why silver is poised for dramatic price increases. The more unstable the global economy, the higher the demand for silver. Farber also highlights that economic instability in emerging markets can have a profound impact on silver prices. Countries like Argentina and Turkey have faced severe currency devaluations, leading their citizens to seek refuge in precious metals. This trend is likely to continue as more emerging markets grapple with economic challenges. The demand for silver in these regions can significantly boost its price on the global market. Another crucial factor is the potential collapse of fiat currencies. Farber is particularly critical of fiat currencies and predicts that their demise is a matter of when, not if. As confidence in fiat money erodes, people will seek out tangible assets that hold intrinsic value. Silver, with its long history as a monetary metal, becomes an attractive option. This shift from fiat currencies to silver could drive a substantial increase in its price. Furthermore, Farber discusses how economic instability can lead to increased government intervention in markets. This includes measures like capital controls, which restrict the flow of money and assets. In such scenarios, individuals and institutions often move their wealth into silver to protect it from government seizure or devaluation. This further increases the demand for silver. The potential for geopolitical tensions to exacerbate economic instability cannot be ignored. Farber points out that rising geopolitical risks, such as trade wars, military conflicts, and diplomatic disputes, create an environment of uncertainty. Investors wary of these risks often turn to precious metals as a hedge. The ongoing tensions between major powers, including the US, China, and Russia, add another layer of complexity and potential volatility to the global economy. All these factors intertwine to create a compelling case for silver as a safe haven asset during times of economic instability. The flight to safety is a well-documented phenomenon, and silver stands to benefit immensely from it. But this is not the end of the story. The intricate dance of supply constraints and rising demand amid economic chaos sets the stage for what could be the most significant bull run in silver's history. So, what strategic moves can investors make to capitalize on this potential? Rafi Farber advocates for direct investment in physical silver over paper assets, a strategy we'll explore in the next segment. By understanding Farber's strategic recommendations, you can better position yourself to benefit from the unfolding economic turmoil and the corresponding surge in silver prices. If you're finding this analysis insightful, don't forget to subscribe to our channel for more expert breakdowns. And let us know in the comments, what do you think is the biggest economic risk facing the world today? Share your thoughts as we continue to unravel the forces driving silver's rise to $1,000 an ounce. Next, we'll delve into Rafi Farber's strategic recommendations for investing in silver and why holding physical silver could be your best bet. Stay tuned.
It happens at every point in the business cycle. Whenever you have a monetary system based on debt, if you stop growing that debt, you will crash. Right? That's exactly what happened back in 1929 and 1873. And was it 1850, 1858, or this happened all the time in the 19th century and the 20th century. This is just the latest version of it, but it just keeps getting more modernized. But it's the same concept. You have to people get into more and more and more debt, and then when you buy more and more stuff, you look richer and richer and richer, but you're actually poorer and poorer and poorer. When that poverty is revealed, it's like all of a sudden nobody has anything. Right? Except the people that have, real capital, and they can buy all the stuff that everyone's defaulting on. And then you have these really imbalanced situations where people that have, gold and silver have way too much stuff. We're going to have to figure out what to do with all that and how to redistribute it. It's going to be a problem because, we don't. The point isn't to get as rich as possible. The point is to help reestablish a working monetary and division of labor system. That's not really a wealth. It's not really a wealth objective. It's a stability objective, which is why we do what we do, hopefully.
Now that we've explored the various economic instabilities driving up silver's potential, let's dive into Rafi Farber's strategic recommendations for capitalizing on this precious metal. Farber advocates for direct investment in physical silver over paper assets, emphasizing the security and profitability of this approach. Understanding his rationale can help you make informed decisions about your investments. First and foremost, Farber is highly critical of the manipulation within the paper-silver markets. These markets are dominated by contracts and derivatives that represent claims on silver, but are not backed by physical metal. This disconnect between paper and physical silver creates opportunities for price manipulation. Large financial institutions can flood the market with paper silver, artificially suppressing prices. Farber argues that this manipulation hides the true value of silver and creates a precarious situation where the paper market could collapse, leaving many investors with worthless contracts. In contrast, physical silver is a tangible asset. When you hold physical silver, you own a real valuable commodity that isn't subject to the same risks as paper assets. Farber strongly recommends buying physical silver in the form of coins, bars, or rounds. These physical holdings are not only a hedge against market manipulation, but also provide security during economic crises. If the financial system were to collapse, physical silver would still retain its value, unlike paper assets that could become worthless overnight. Farber also discusses the strategic move known as raiding the COMEX. The COMEX, or Commodity Exchange, is a major market for trading metals like silver. By purchasing physical silver and taking delivery of it, investors can expose the disparity between the physical and paper markets. This strategy forces the COMEX to deliver actual silver, revealing the extent of the manipulation and potentially driving up prices as the true scarcity of silver becomes evident. Another key recommendation from Farber is to avoid storing all your silver in one place. Diversification of storage locations can protect your holdings from theft, natural disasters, or government seizures. Consider using a combination of home storage, secure vaults, and international depositories. This approach not only enhances security but also provides flexibility in accessing your assets when needed. Farber also suggests keeping an eye on silver mining stocks. While he primarily advocates for physical silver, he acknowledges that certain mining stocks can offer substantial returns. These companies benefit directly from rising silver prices, and their stocks can appreciate significantly during a bull market. However, he cautions that mining stocks come with their own risks, including operational challenges and market volatility. Therefore, any investment in mining stocks should be carefully considered and should not replace physical silver holdings. An often overlooked aspect of Farber's strategy is the importance of liquidity. Physical silver is relatively easy to buy and sell, making it a liquid asset. During times of economic distress, having liquid assets is crucial. You need the ability to quickly convert your holdings into cash or other essential goods and services. Farber highlights that physical silver provides this flexibility, especially compared to other investments like real estate, which can be harder to liquidate quickly. Farber's strategic recommendations are not just about profit, they're about preserving wealth and ensuring financial security in uncertain times. By focusing on physical silver and understanding the dynamics of the market, you can better position yourself to navigate economic turmoil. He stresses the importance of staying informed and adaptable, as market conditions can change rapidly. As we move forward, it's essential to look at the long-term prospects of silver. Farber remains extremely optimistic, coining terms like silver swan to describe scenarios where silver prices skyrocket due to a combination of economic factors and market corrections. Understanding these future prospects can help you prepare for what lies ahead and make the most of silver's potential. If you're finding these insights valuable, don't forget to subscribe to our channel for more expert analysis and share your thoughts. What's your preferred strategy for investing in silver? Let us know in the comments below as we continue to explore the forces driving silver's rise to $1,000 an ounce. Next, we'll delve into the future prospects of silver and how Farber's analysis suggests dramatic changes in the market are on the horizon. Stay tuned.
It could be. I mean, if I understood more about what exactly causes reserves to rise and fall on a weekly basis, which I admit I don't have all the answers to those questions. I can't say what is causing the weekly wiggles. But I do see the wide correlation, a tight correlation before 2020 and the wide correlation now from 2020 to 2024. So if we're back to the levels we were at 2020 at these levels in the balance sheet, we should continue down from here. And look, we might not. This could be another false alarm. But whether it is or it isn't, if it takes another month or two or whatever, as long as the Fed isn't expanding his balance sheet, there's going to be pressure on reserves. There are other factors here. They could loosen up on regulations on how to accumulate more debt or whatever, and that might influence reserves positively and push them up again. It's like you're trying to wring out a towel of all of its juice, and you can't do it with your hands anymore. So you bring a hydraulic press or something, and that gets the last few drops out. So that's what I'm saying. Like, I don't know exactly what they can use to try to push reserves up, even if they're continuing QT, but I do know that they can't keep.
Looking ahead, Rafi Farber remains extremely optimistic about silver's future prospects. He believes that the economic and market dynamics we discussed are setting the stage for dramatic changes in the silver market, potentially driving prices to unprecedented highs. Let's explore these future prospects and what they mean for you as an investor. Farber often uses the term silver swan to describe a scenario where silver prices skyrocket due to a convergence of economic factors and market corrections. This concept is analogous to the black swan events described by Nassim Nicholas Taleb, rare and unpredictable occurrences that have a massive impact. For silver, a silver swan event could be triggered by a combination of factors such as a major financial crisis, a sudden increase in industrial demand, or a significant geopolitical event. One of the critical factors driving this bullish outlook is the expected rise in global silver demand. The Silver Institute projects that global silver demand will rise to 1.2 billion ounces in 2024, driven by industrial uses in photovoltaics, solar panels, the automotive industry, and electronics. This significant demand increase underscores the tight supply conditions that Farber often mentions. As industries continue to innovate and expand, the demand for silver, a crucial component in many technologies, is set to grow exponentially. Additionally, the investment demand for silver is expected to surge. As we discussed, economic instability and declining confidence in fiat currencies are pushing more investors towards safe haven assets like silver. Farber predicts that as more people recognize the inherent value of silver and its potential to preserve wealth, investment demand will soar. This shift in investor behavior could drive silver prices to new heights. Farber also highlights the role of monetary policies in shaping silver's future. Central banks around the world are grappling with high inflation and slow economic growth. In response, many have resorted to quantitative easing and other measures that increase the money supply. These policies devalue fiat currencies and increase the attractiveness of tangible assets like silver. As these monetary policies continue, the value proposition of silver becomes even stronger. Geopolitical tensions are another significant factor. Ongoing conflicts and trade disputes create uncertainty and risk in global markets. Investors, seeking stability, often turn to precious metals as a hedge. Farber points out that any major geopolitical event, such as an escalation in trade wars or a new military conflict, could trigger a flight to safety and push silver prices higher. Another intriguing aspect of Farber's analysis is the potential for market corrections to expose the true value of silver. The disconnect between the physical and paper silver markets creates an environment ripe for a correction. When the true scarcity of physical silver becomes apparent, prices could rise rapidly. This correction could be sparked by increased demand for physical delivery or by regulatory changes that curb market manipulation. Farber's long-term outlook suggests that silver is not just poised for short-term gains, but is on a path to sustained growth. He predicts that silver could reach triple-digit prices if these economic and market conditions unfold as expected. This growth isn't just about speculative gains. It's about the fundamental value of silver as both an industrial commodity and a monetary asset. To prepare for these dramatic changes, Farber advises investors to stay informed and proactive. Monitoring economic indicators, staying updated on market trends, and understanding the broader geopolitical landscape are crucial. He emphasizes the importance of holding physical silver and being ready to act quickly as market conditions evolve. In conclusion, the future prospects for silver are incredibly bullish, according to Rafi Farber. The convergence of economic instability, rising industrial and investment demand, and potential market corrections create a perfect storm for silver prices to soar. As we navigate these uncertain times, positioning yourself with physical silver could be one of the best financial decisions you make. If you found this analysis valuable, make sure to subscribe to our channel for more expert insights and timely updates. And we want to hear from you. How high do you think silver prices will go? Share your predictions in the comments below. Next, we'll wrap up with the apex of Farber's analysis, tying together all the factors we discussed and providing a comprehensive conclusion on why silver could reach $1,000 an ounce. Stay tuned.
Fail. And then you had the regional bank bailout, and after the regional bank bailout, then you had a slight rise in reserves. The thing is that every time that it seems that that reserves go to a point where they were before the previous QT, before the previous QE. So let's say they're doing QE1 and the balance sheet goes to whatever level, and then they do after QE2 and QE3 they do QT, and then it goes to a point where before the previous QE started, then you have a crisis, right? That's what happened in 2019 when I talk about this a lot. The apocalypse and the repo markets just got clogged up, and there weren't enough dollars. So that happened in 2019 when the QT that was there to reverse QE3 hit a level that the balance sheet was on prior to QE3, right? And then you had a crisis. So you have the same thing with around $3 trillion with the regional banking crisis. And now the question is, if QT has been continuing, if they've been shrinking the balance sheet week after week after week, and they have, and they're saying they're slowing it down, but we haven't really seen the slowdown yet, then why are reserves not falling as hard? And I don't know the answer as to why the correlation isn't as tight, but if you look at data points, right, and not the correlation throughout from 2020 to 2024, if you look at data points, then when the balance sheet was at the balance sheet from 2020, the reserves level is the same as it is now. So on a wider space, we still have that correlation, whereas what's happening in the middle is a little bit off kilter. And I have some theories about why that is, but we could talk about that as we progress. So basically the point is that I see bank reserves starting to fall now from around, I'm looking at this chart, so from April 10th, after tax day, they started to fall. We were at 3.6 trillion and now we're at 3.26. So That's the biggest fall since before the regional banking bailout. So I think we might be at a point where the bank reserves are going to start to fall, and once we hit $3 trillion or somewhere near there, then there's going to be another crunch in some sector of the banking.
As we approach the culmination of Rafi Farber's analysis, it's time to tie together all the factors we've discussed and provide a comprehensive conclusion on why silver could reach $1,000 an ounce. This apex will not only summarize the key points, but also underscore the logical progression that makes this prediction plausible. The biggest financial crash in human history is on the horizon, driven by a confluence of over-leveraged banks, a rapidly declining dollar, and inevitable hyperinflation. These factors create an environment where traditional fiat currencies and financial instruments lose their reliability, pushing investors towards tangible assets like silver. Over-leveraged banks. Our financial institutions are teetering on a precarious edge, holding massive amounts of debt that far exceed their actual reserves. This over-leveraging means that any significant economic shock could cause a cascade of bank failures, similar to, but potentially much worse than, the 2008 financial crisis. As trust in these institutions erodes, investors will seek out safer assets, driving up the demand and price of silver. Declining dollar value. The US dollar is losing its value and status as the world's reserve currency. This decline is exacerbated by the Federal Reserve's monetary policies, including endless money printing and low interest rates, which devalue the currency. As the dollar weakens, both domestic and international investors will look for more stable stores of value, with silver being a prime candidate. Hyperinflation. Hyperinflation is not just a distant threat, it's a looming reality. As we've seen in countries like Venezuela and Zimbabwe, hyperinflation can decimate a currency's value almost overnight. Farber warns that the US is on a similar path, and when hyperinflation hits, the demand for silver will skyrocket as people rush to preserve their wealth. Supply constraints. The physical supply of silver is under significant strain. With increasing industrial demand from sectors like electronics, solar energy, and medical technologies, coupled with declining mining outputs, the market is facing a supply crunch. This imbalance between supply and demand will drive silver prices up as the scarcity becomes apparent. Economic instability. Economic instability on a global scale further fuels the bullish case for silver. Financial crises, political upheavals, and geopolitical tensions all contribute to a climate of uncertainty. Investors seeking safe havens during these turbulent times will turn to silver, boosting its price. Strategic recommendations. Farber's advice to invest in physical silver over paper assets is crucial. Physical silver is a tangible asset that isn't subject to the same risks as paper silver, which can be manipulated and may not be backed by actual metal. By holding physical silver, investors can ensure their wealth is protected even if the financial system collapses. Future prospects. Looking ahead, the potential for silver is incredibly bullish. The combination of economic factors, market dynamics, and strategic investor moves sets the stage for a significant bull run. Farber's concept of the silver swan event, a rare but impactful occurrence where silver prices soar, illustrates the dramatic potential for this metal. In summary, the convergence of these factors creates a perfect storm for silver. Over-leveraged banks, a declining dollar, hyperinflation, supply constraints, economic instability, and strategic investment recommendations all point towards a massive increase in silver prices. Farber's prediction of silver reaching $1,000 an ounce is not just a sensational claim. It's a logical outcome based on thorough analysis and historical precedents. As we navigate these unprecedented times, staying informed and proactive is essential. By understanding and acting on these insights, you can position yourself to benefit from silver's potential rise. Remember, this analysis is not financial advice. Always do your own research and consider your individual circumstances. Stay informed, stay prepared, and stay tuned to our channel for more expert analysis and insights. If you haven't already, make sure to subscribe and hit the notification bell so you don't miss out on our latest updates. And remember, your thoughts are valuable to us. How high do you think silver prices will go? Share your predictions in the comments below. This is not financial advice. Always consult with a financial advisor before making any investment decisions. Thank you for watching, and until next time, stay safe and stay smart. We journey through the critical factors that Rafi Farber identifies as the catalyst for silver's potential meteoric rise. Now let's tie it all together and understand why this convergence of circumstances could lead to silver reaching $1,000 an ounce. To begin, it's important to revisit the sheer scale of the financial vulnerabilities we've uncovered. Over-leveraged banks are sitting on a knife's edge, with debts far outweighing their reserves. This creates a fragile financial ecosystem where a single shock can trigger a cascade of failures, much like the domino effect witnessed during the 2008 financial crisis, but on a potentially larger scale. As these institutions wobble, the reliability of traditional investments diminishes, pushing investors towards the stability of precious metals. The declining value of the US dollar plays a pivotal role in this scenario. With the Federal Reserve's policies of continuous money printing and maintaining low interest rates, the dollar's purchasing power is eroding. This devaluation not only impacts the domestic economy, but also reduces the dollar's appeal as the world's reserve currency. In times of such monetary uncertainty, silver's appeal as a store of value becomes significantly more pronounced. Hyperinflation is the third critical element. Historical instances of hyperinflation, from Weimar Germany to modern-day Venezuela, show how quickly a currency can lose its value. Farber's warnings are clear. The U.S. is on a similar path, with the dollar's devaluation potentially spiraling into hyperinflation. In such a scenario, silver's role as a hedge against currency devaluation will drive its demand sky high. Supply constraints further complicate the picture. The physical silver market is under severe pressure due to high industrial demand and declining mining outputs. Countries like India and China are consuming large quantities of silver for both traditional and technological purposes. This intense demand, coupled with limited supply, sets the stage for a significant price surge. Economic instability amplifies all these factors. Global financial crises, political upheavals, and geopolitical tensions create an environment of uncertainty and fear. Historically, such instability drives investors to seek safe haven assets like silver. The current global landscape, fraught with economic and political risks, supports Farber's prediction of a silver boom. In the face of these complexities, Farber's strategic recommendations to invest in physical silver stand out. Physical silver, unlike paper silver, is a tangible asset that retains value even when financial markets falter. By focusing on physical holdings, investors can safeguard their wealth against the manipulations and risks inherent in the paper silver market. Looking to the future prospects, the concept of a silver swan event becomes more tangible. A confluence of economic crises, increased industrial demand, and exposed market manipulations could indeed propel silver to unprecedented heights. Farber's analysis paints a picture of a market ripe for dramatic corrections, where silver's true value is finally recognized. In summary, the path to $1,000 silver is not just a speculative dream. It's a logical outcome of interconnected economic factors. Over-leveraged banks, a weakening dollar, impending hyperinflation, tight supply constraints, and global economic instability all point towards a massive revaluation of silver. Farber's insights provide a roadmap for navigating these turbulent times, emphasizing the importance of holding physical silver as a hedge against systemic risks. As we conclude this comprehensive analysis, remember that these insights are meant to inform and prepare you, not to dictate specific financial decisions. Always conduct your own research and consult with a financial advisor to tailor strategies to your individual needs and circumstances. Thank you for joining us on this deep dive into the potential future of silver. If you found this analysis valuable, please subscribe to our channel for more expert insights and timely updates. Your feedback is crucial. How high do you think silver prices can go? Share your thoughts and predictions in the comments below. And always remember, this is not financial advice. Stay informed, stay prepared, and until next time, stay safe and stay smart.